Hey guys, Mike here. So sorry I couldn't put a video out last night, but I was on the road all day to go get my mother so she can watch our dog since we will be on vacation as you're watching this right here. But I did want to put a video out for you guys and kind of start what we did last time when I went on vacation. You guys seem to like that. And so this is the latest video as far as I got on what Jim Carson talked about with his prediction. I want to also kind of pull back the curtain and talk about why he's predicting what he's predicting and the time he's predicting this in, okay? So, we'll go into what he was talking about, just FYI. Remember, he's the one that, hit quite a few things going forward, but then still talks about, and he's still sticking with it, that third, fourth quarters, when you're going to start to see the decline, and the decline he is predicting would have to ensue a recession, basically. You can't have his prediction come true if there's no recession. We don't go into that much without a recession, but also remember, what do recessions do? They drag out for long periods of time. That's why it's important to understand what he's talking about here. And it's all based on inflation and the 10-year yield going way up. Okay, that's the big thing you got to think about. At the end of this video, I meant to put this in last night's video if I did one, but I didn't get back till like 8 o'clock. So I was on the road from like 7:30 to 8 almost the whole time. So I was exhausted. But I was, on Memorial Day, I was sitting there eating dinner, and late last night, it was literally right before it actually got dark. And I started seeing this Twitter feed come through with everybody running the Murf, M-U-R-P-H, in honor of the fallen veterans for Memorial Day. And I'm sitting there eating dinner, and I was like, you know what, I'm going to go do that too. So finished dinner, got my shoes, got some shorts on, and went and did it. And I recorded some videos I was going to put in last night's, video and stuff for you guys on Tuesday to talk about and stuff, because I thought, it was interesting to say the least. I've actually never run a Murf before. But again, I was in the military a long time ago, not a spring chicken here. And I'll definitely tell you, as you'll see in the video, never do it without preparation, because I definitely was not hydrated, that's for sure. And never do it after you just ate dinner. But I'll put that at the end of this video, probably for you guys to have a good laugh at, I guess. But anyway, I did it, accomplished it. So, appreciate all that. Just want to let you see a little bit of the insight on that. So let's get started with one, remember, he's picking the period, and we'll get into what he's talking about here in a minute, right after this. But he's picking third quarter, right? Where you start to see this decline, right? So I want to show you why real quick on that, and then we'll listen to what he has to say as far as what his prediction was, what he's still talking about, and what he's still looking for now. When we look at this, you can first of all see that the last few days of July, August, September, again, can be rough. First, maybe 5 to 12 days of October as well. And you might remember last year in 2024, we took that 10% dip down there in July to August. But you can see as you just pull out of this, like you're talking about from like July to October, you're basically flat at this point in time. It just gets really rough. And a lot of this, as Jim Carson always talks about, has to do with the OpExes and stuff, okay? Especially those quarterly OpExes going into that. And we'll also talk about what's going to happen here coming up in June if we don't get a lot of weakness at the end of May, early June as well. And so to continue on with this, just look at going back in this over the last 10 years of what it's looking like in the third quarter, especially because that sell May and go away doesn't exist anymore. Once the government took it over, that went away. It's really almost like, sell it the middle of July, end of July, and go away. I'm just kidding, don't ever do that. But that's when you really see some rough times here, as you can see. And so you see that in 2023, we got a nice sell down. Here we are in a major market crash, so we get one of these bear market rallies. But again, you'll see September is the worst month. I don't care how far you go back, but even just going back 10, 11 years, which I'm going to do, because that's really all I care about right now. And this has changed, right? It used to be sell in May and go away, but now it seems like sell in August and go away, maybe even the end of July, right? You see 2021 right here, super bullish, right? Super bullish. So here's, that's the end of July. We come up, boom. Here comes September, though. Time to pee in your Cheerios, And so you'll see a lot of these, that 2-month span from August, September, maybe in early October, sometimes it just end up flat, but it's super volatile. Like you'll see it's just super, super volatile, especially if you've had a strong May, June, and early July. It's even worse, right? Here's 2020 where they're pumping $7 trillion in our economy right here. Here's August, boom, moving up. And it goes up. Here comes September. See you later. Pee in your Cheerios again. Right? September is just horrible. And so again, this one ends up being positive. It does end up being a positive. But then here comes, early October to mid-October. So just rough, right? But you had a strong May, strong June, strong July, right? And so that means if you have a weak May, June, July, maybe you have a stronger August, September, that kind of thing. But you can see this going back. Here's 2019. You just look at the chart. and go, man, that just doesn't look very cool, right? I mean, you're going to end up going sideways. Again, it goes down in August, comes back up. Oh boy, here we go. And so again, we end up slightly red, but again, volatile, and especially if you're in options, unless you're in, well, you're just getting messed up all over the place. You're writing this now on puts or calls. But, you know, you look at this right here. Here's 2018. This one was actually really good. Why was it really good, though? You always have to ask yourself this. You go, why was August? And again, it's very volatile. You see the big swings up and down. But when you look, wow, it's actually up, right? Pretty good. And then you go over to the right a little bit and you realize, oh, man, we went through a market crash. This was the 2018 from October to December 24th crash, right? So what does the market love to do when it runs up into this? It loves to run up, right? It loves to get everybody in, then go, okay, pull the rug. So that might be why that happens, because you won't see too many green or really, well, especially really green months or anything from August to September here. We got 2017. You can look at the chart and already go, well, that's not going to be very good, right? Again, super volatile, doesn't look great. Chart looks like crap, basically. Then, of course, we end up going up. Hey, great, we saved the day right here at the very last minute. And then the fourth quarter kicks in and everybody's loving life, right? So that mid-October to going into December. Then you go in 2016. Again, it's going to be flat, super volatile. You can see how it's going to sell down right there. And so, again, not anything good going on there in the market. No surprise there. And then we go over to 2015. And we don't even have to measure this, do we? I'm going to do it for the fun of it. But, man, here comes August. Here we go. And it's like, oh, boy, crashing all the way down, up, down again, down about 11% down right there. And so that was horrible. Not a good one. 2014, you come over here. You can see here comes August, the end of July and August, right? The last week of July, August. So it sells down right here. There's August starts right there, comes up, goes over. September, not too bad. I mean, September's basically flat. And then we end up slightly up about 1%. And then that first, you see October is not good going to that one. And it has a lot to do with the OPEX. It's like these sell downs usually come like very close right after the expiration. OPEX has gone to the wayside. Again, I'll show you another video I'm going to put up for you guys kind of talking about this. Was one that I did for the members, and you can see that. But let's get in real quick for those who can't remember what Jim Carson was talking about and what he sees coming here.
We got the decline, Feb OPEX to March OPEX almost exactly. And then, we talked about the big bounce and the big bounce off this initial kind of warning shot is what I called it in December and January that was coming. We thought in December, January, we said would likely come all the way back near the highs or even reach the highs. That was the original thought. And then after Trump rolled out the massive tariff kind of play and the desire to kind of go the supply side route where they really shocked demand and pulled it out of the system and tried to force the Fed's hand into monetary policy, et cetera, which failed to get the 10-year down, right? Once that failed and he pivoted, our view was like there was enough uncertainty and alienation of buyers that that ceiling probably had come down and a 40% long-term decline that we're still very adamant about is still likely to come, if not be worse. When the realities, which are working out over time and overhang of supply, which we can get to, and whatnot, are ultimately going to weigh on this market and take it down 40% plus by middle of next year. And that's what we've been saying again for almost 6 months to a year. We've been saying this, still believe that reality.
And now this is the key here. So when he did this one, it was like right around March OPEX and stuff, right? So maybe 10, 12 days, whatever it's been. And he was talking in that interview, he was saying, now, if we don't get weakness, which we started to see a little bit of, but we haven't yet, okay, out of this right here, and all of a sudden we just keep seeing strength, the market keeps holding up through the end of May, going into June, well, what happens? And this is key here.
Otherwise, the June OPEX becomes supportive. Because if you don't start getting a decline early, then those bond and charm flows, all that open interest is supportive. And then you get into the summer and you can get into this kind of summer of George dynamic, which we called for last year. And we've done, we've highlighted several times before where vol can get really compressed and get in a loop of just vol compression. And so we're really at this fork where we're either going to decline back to below, I would say, 5,600, which is not that far, right? And this next, maybe that stretches to 5,300. So 50, get back into this 53 to 5,600 decline by June OPEX, right? End the quarter below the quarter close, or the open of the quarter. So it would have our second, if that happens, would have our second consecutive quarterly decline, which I think is very important. And I think more likely scenario. I want to be clear, still believe that to be true. But it doesn't mean a collapse or a return to the lows at this point. It just means an incremental kind of stair step, at moments feeling stressful, but for the most part, a relatively orderly decline back into the middle of this range in a continued quarter over quarter decline. And then we believe starting more in the August range, that after maybe another little bit of kind of chop, that we start to decline into the late Q3, and then more aggressively into Q4, and then really being probably near the lows at the end of the year would be my base case at this point, with a bigger candle set of decline coming next year.
And so, of course, what he is describing is simply, you can see that, a recession. That's what that is. And, you can go back to .com, you can go back to 08 and see the market started to decline. Then we went into recession. That's what dragged it out. Okay, so that is, again, his prediction will never come true unless there is a recession. That's just the way it is. I mean, and remember, there's no official definition for a recession. You can sit there and Google all you want. Some people say, oh, it's 2 quarters, negative quarter, and all this fun stuff. And you saw what happened last quarter. I told you guys, don't take that serious, man. When you got imports coming in, especially people front loading, it throws everything off. Okay, we had it happen in 2022. Nutty to think that's a recession. Give me a break. In certain parts of the country, I'm sure it felt that way, but no. I mean, come on now. And so, but you have to have that for this to come true. And again, when you look at the 10-year yield, and we've been talking about this, they want it down because of all this debt reissuance and all that fun stuff. And he's talking about going up to he didn't even mention this interview, but he was talking about how the 10-year yield, he's predicting 6%. That is a big move. I mean, that is a massive move. So in order for his prediction to come true, that's part of the equation, right? Is for yields to go much higher from here, which of course he thinks inflation is going to go higher. And maybe that has to do with tariffs. Maybe it doesn't. That's what we're going to have to see. But when you look at the market right now, we're not seeing that sign of weakness. Inflation is not going out of control. The yields have definitely been going out of control. The big thing is, what we don't know is, we know the tax cuts and stuff, and that bill got passed last time, the market just spiked on a big run. The difference in now and then is the deficit. The deficit has just been blown out. And so whatever's in this bill, that we got to see how the bond market is going to react. Because the whole point was, remember, they're having to raise the debt ceiling $4 trillion, because you try to pay for this stuff, but it's not paid for. That's just the way it is. And the more tax cuts you add on, less revenue you bring in, boom, right? And so if that budget deficit, or if that bill is seen as increasing the budget deficit, how's the bond market going to react? Because if it's increasing the budget deficit, which we don't know yet, again, that means more bonds and treasury are going to have to be issued. Okay, so supply is going to become huge. It's going to increase. And since we got the downgrade already, and people were saying, oh, you're riskier now than you were before because this huge $2 trillion budget deficit, well, what are they going to want? What are yields going to do? That's what we got to watch for when that passes, for sure. Because the stock market can love it, and the yields go, nope, sorry, and just start going up. And then eventually you get a point where the bond market starts, or the stock market goes, oh boy, that's not good, okay? Because bond yields, or the stock market and yields, you'll see they go up the same until you hit a certain point, and then the market freaks out. But right now you're in this May, June, July, which is usually bullish months, so to speak, and at least recently they have been over the last few years and stuff. So that's what we got to see how this plays out. Again, it's a big predictions, got some pretty much a lot of detail in it and stuff, and we'll see if it happens or not. And if not, then, he gets leprosy, just like Mike Wilson did back in 2023, and nobody wants to talk to him again. So that's kind of how it works. But anyway, I hope you guys got something out of it. Again, I should be in Glacier National Park at this point in time, enjoying that. Got other videos planned for you guys and stuff. I did put out another Saturday's video with all the places you had. Again, so I put that in this Saturday video coming up, so you definitely will get that. And some others. Make sure to watch Thursday, because obviously that has to do with Friday. That's when you actually need that for sure. But you'll be able to use that going forward from now on in. So anyway, I hope you got something out of it. Enjoy the videos, me almost, having a heart attack last night trying to do the Murf and stuff like that. And for those who are unfamiliar, the Murf is mile run out. You come back, you got 100 pull-ups, 200 push-ups, 300 squats, and you do another mile run. So you time yourself. So I was actually pretty proud of my time for my age. So we'll see how it goes. So anyway, enjoy that. Hit that like, subscribe button on your way out, guys. Think about signing for the membership, less than McDonald's combo, and I'll see you guys later. All right, guys, last minute decision here to say dinner, but aside to honor the fallen veterans, I'm going to do the Murf 1 mile run, 100 pull-ups, 200 push-ups, 300 squats, and then a mile run. For time, I'll let you know tomorrow what I get. I hadn't ran in 3 years, so this ought to be pretty interesting. So, on the way back from the first mile, note to self, never do something like this right after eating dinner. Really bad idea. All right, first mile done. How many is that? 50 pull-ups out of 100, 125 push-ups out of 200, and 100 squats out of 300. Try to keep it going. All right, so doing the push-ups, 13 more pull-ups, and I don't know, a little more squats, I guess. We'll see how it goes. All right, pull-ups done. Almost cheated myself. When you get oxygen deprived, hard to count, so I had to go back and do 5 more. That's 100 pull-ups. All right, got 300 squats, 200 pull-ups. I'm sorry, 100 pull-ups, 200 push-ups, 300 squats. 34 minutes right now. Fixing to go on for the last mile. Wish me luck. On the home stretch. You can see it's getting dark. Like I said, I started this after dinner. No preparation whatsoever. Whew. The squats got me. Legs are cramping. I'll see you at the finish line, guys. Let's see if I can get this to record. There we go. There's my time, just in case. I'm too old to know how to record the screen on my phone.